Hi there, everyone. Welcome to It's a Number Game podcast. And today we've got something slightly different. This is Adam Morris from MSP Finance Team. And today we're going to work through an online tool, which I hope you'll find very useful. And presumably you're here because you're really interested to know the question of how much is enough when it comes to working out what valuation you need to get for your business. So today I am going to introduce a tool to you which I personally have found very useful and indeed continue to use it and play with it. And the tool is called FIRECalc. You may have come across it, maybe not. I think it's relatively unknown out there. And as far as I'm aware, a lot of IFAs don't use this tool. They use something else, probably around cash flow analysis, and maybe that'll use Monte Carlo calculations, which we might touch on later. But this tool is a little bit different, and this is why I want to bring it to your attention. And what's the question here? Why are we talking about this? And I think the reason I wanted to go through is because it's a hugely important question to ask. And it's also very complex. And there's a lot of risk associated with not getting close to the right answer. So on the one hand, you don't want to undershoot and not create the level of capital that you need in your retirement, or for whatever else you choose in life. But on the other hand, your business or a lot of your personal wealth is tied up in a single stock, if you like, your MSP. And with that comes risk. And so, do you want to keep that business going with all of the effort required and potentially find out you have way more than you'll ever need and you overshoot your target? And that additional money, whilst it's nice to have, doesn't actually provide you with actual utility, I guess. So this is why it's important. So let's dig in. So you can see the tool here in front of you, and I'm just going to quickly get to grips with it in terms of explaining roughly what it does. And the main difference between this and other tools is it bases your projections on, not on scenarios around growth rates, inflation rates, and things like that. Based purely on what has actually happened since 1873, I think it is. And that way, it's a different way of looking at how your calculations or your projections may work out. Anyway, this is best explained if I actually just run a scenario. So I think what we'll do is, if you look at here, we've got start here, and we've got a spending figure, a portfolio figure, initial portfolio figure, and the years that we want to spend that amount each year. And so what we'll do is we'll start off with a 3 million portfolio figure. Make sure I get enough, the right number of zeros in there. We'll say we're in for 40 years, and we'll say that we've got an annual spending of 150,000, say. So look, these are just made up figures. Obviously, you need to start with something that's close to what you're looking for. 150 may be higher, it may be lower. But a 3 million figure is probably not a crazy starting point from the perspective of this particular scenario. So let's just submit this now. And what we'll see here is the results of this. And we can see that we have a graph here, which looks crazy, but this is all of the 114 cycles throughout history when we started to measure the stock markets. And we can see what happened in each of those eventualities if we invested 3 million. And we can see, according to this, that the outcomes ranged after 40 years from a negative 8 million to a positive 30 million. And that the average at the end of this 40-year cycle was 3 million. And this is inflation adjusted. So we don't need to worry about the 3 million in 40 years' time being worth a lot less than that. It's in today's money. So that's one of the beauties of this tool also. It makes it far, far simpler. And then there's a key stat here which says that FIRECalc found 46 cycles that failed for a success rate of 59%. So clearly what we're looking to do here is we're looking to work on data that gives us a higher level of confidence that it's going to work. And that's subjective. Obviously, we can determine what we want in terms of that level of risk. Now, what I'm going to do is take us straight away to a scenario here, which is about what our starting portfolio needs to be. So given a success rate, determine spending level for a set portfolio or portfolio for a set spending level. So if we now run this, we're going to now get a little graph here, which starts to tell us that if we increase our 3 million total investment target to 4.5 million, we actually arrive at 100% success rate for that 150,000 a year. And you can see how the success percentages drop as our initial investment is lower. So this starts helping us think about what kind of figure we need to work towards. But what I've just shown you is the basic starting point. Now we need to get onto working through a bit more detail, because this can make a huge amount of difference. And actually, it's quite surprising what we can achieve just by adding some additional detail into this. So we'll stick with this initial scenario here. But what we'll start to do is populate some other fields. And the first thing we're going to do is we're going to add in our state pensions. I don't know exactly what these are today, but I think they're around about 10,000. And let's say we're married. And I'm going to leave those figures there, 2037, 2039 for when those kick in, which is about, whatever that is, 15 years' time. So that puts this scenario at an age of about, 52, 53, something like that. And we're going to submit that. And that's made a bit of a difference, but not a huge difference. We're now going to go into spending models. Now, this is really interesting. Actually, before we do that, let's go to portfolio. And I'm just going to show you here that you can adjust what type of portfolio you have. I'm not going to spend a lot of time on this, but we're going to stick with a total market portfolio for this example, and we're going to stick with a 75% equity to bond ratio. The only thing I'm going to do slightly is just increase this fees here, because I think that's on the low side. And we're just going to call that 0.3, just to perhaps make that a bit more accurate. Obviously, the fees that you pay for your investments can be anywhere from 0.1 to 2%. And, they can make a huge amount of difference. In fact, you can investigate the difference that they make. So, but we're going to stick with the total market here, and at 75% on that equity ratio. But let's just submit that. And that wouldn't have made much difference, just that one adjustment, and it hasn't. And now we're going to come back to our spending model. And the current spending model that we've based this scenario on is based on a constant spending power, i.e. I want to spend 150,000 a year, each year, every year until I die. And the reality is that that's not going to be the case. The reality is you're going to want to spend less as you get older and older. If you're well into your 80s, you're not going to be spending the same amount that you are in your 60s or 50s. You're just not going to be. So there's different models that we can play around here. There's the Wernicke model, which is about adjusting your spending once you get to 56 or older. And that's a great model. I like that very much. There is also a percentage of remaining portfolio, which you can work on. But let's have a look at this Wernicke retirement model. And let's say we're 55 today. And we could submit that. And what we can see now is because we're willing to spend less than 150, a lot less, and we'll come on to that in a second, when we're a lot older, the amount we need now has reduced significantly from over 4 million to 2.8 million at 100% risk. In fact, it drops down to just over 2.3 million, just under 2.3 million. 2.3 million at about 83% risk. So there's kind of a huge difference there. And we can also go into portfolio changes. This is something else we might want to look at. So, for example, we might say we've got an inheritance coming our way. So let's just say there's 300,000 coming in as an inheritance, and perhaps that's coming in 2030, let's say. So we can submit that. And you know what, though? Maybe we want to also add in a subtraction for some large payment we're putting in, let's say, because we want to help our kids get on the property ladder or something like that. So, and maybe that's going in there, say 2030, 2028. So we'll just put that in. These aren't going to make a huge amount of difference, but it's important to plug in some of these larger numbers that you have plans for. So where does that leave us? About 2.5 billion, 100%. And if we come back to our investigation model and we go back to our how the standard display the results of the retirement plan and submit that, you'll now see this graph here, which describes the Wernicke year-by-year spending plan, and how at 55 we're spending 150,000, but actually 20 years time, when we're 75, we're going to be spending somewhere around that's about 70,000. And you might look at that and you might go, actually, that's absolutely fine. But what is interesting here is we've got 100% success rate, and we can play around with that level of risk. The other thing I quite like to do, and it's completely up to you, of course, but on your portfolio, on your portfolio changes, you might want to think about equity release. Perhaps you've got quite a lot of assets, quite a lot of money tied up in the value of your home. So you might want to add an adjustment in there. Let's just say it's 500,000. Let's say your home's worth $1 million today. So we might say, actually, if things get tight, I'm willing to take out 500,000 in equity release, and I might do that in 2042. Let's just submit that and see what happens. And now we can see that we start off with 3 million, but actually it just keeps growing and growing. And you can see here the impact of putting in that 500,000. It's around that date. So we've got an opportunity here now to increase the level of incomes significantly, because we're overshooting right now. We're overshooting. So if we go back here, and we go back to our start here, let's say we want to increase or start off with 200,000 on this model. Submit that. And now that we can see that we, out of the 114 cycles, we had 4 cycles that failed, which gives us a 96.5% success rate. But we're starting off by spending 200,000. And in fact, even when we are into our 70s, we are now at something like 90,000 of income, considerably different. So this is considerably different from the initial scenario where we were investing 3 million and looking at 150, and we had a low success rate, and now we're at 95% when we're starting to spend 200,000. And if we come back to the investigation piece and we again click on that starting portfolio, we can see here these numbers correlating, and that fact we're looking at 2.9 as a total for that level of success. So I hope that has been useful for you, and you can have a play with this and you can start to triangulate into what might work for you based on historical data of what has actually happened. There's one further thing you can do with this, which is quite useful. Let's say you're not currently planning to sell, but you're planning to sell in 5 years' time. And you can start to play around with how much you currently have, and the difference that will make. And this makes a huge amount of difference, actually. So that's another bit of homework you can take away with you. So have a look at it, see what you think. Interested in any comments you may have around the tool. Just one further point I guess I wanted to make was this doesn't take into consideration capital gains tax. It's not that, well, that would just be far too complex, and it'd probably be US based in any case. So for the gains that you make, you need to factor in some capital gains tax on that 100 or that 200,000, the big portion of that, which is taxable. So that's just something else to bear in mind. But yes, hope you find that useful. Let me know what you think. Thank you, and see you again soon.